Warren Buffett once said that time is the best friend of a great business and the worst enemy of a mediocre one. And I think in the case of Palantir, it's really evident how clear that is. Now, I'm going to answer a simple question in this video. Is Palantir my biggest failure, or is this the beginning of a beautiful friendship between a man and his stock? And let me tell you a few things here. So right now we have this exodus. People are leaving growth stocks as if it was the Titanic. Everybody's running away. The same people who were screaming 7 months ago that value stocks are dead, fundamentals don't matter, everything is all about the story. The same people are now screaming at you, value stock is the thing. You need value, you need profits, you need PE ratios. Fundamentals are everything. And they're being led by Mr. Wiener Schnitzel himself, Jim Cramer, who changes his opinion about everything every couple of months depending on what the mood is. But the question here isn't if the exodus from growth stocks to value stock is justified, because that's a video on its own. The question is, should Palantir be included in this category or not? Because that question, if answered correctly, can make a lot of people a lot of money and can cost a lot of idiots a lot of missed opportunities. So check this out. Let me take a sip of my tea first. Sorry for the obnoxious vocals. Now check this out. When we talk about companies that are not set up for inflation and high interest rates and what you would call fluff story stocks, you're usually talking about stocks with a lot of leverage, a lot of debt on their books, not a lot of sales to prove that what they got actually works, and really not a lot of traction as far as, their business. It's a company that basically burns through cash, doesn't generate any free cash flow, and hasn't really shown us anything besides a really cool story. Now, the question is, why would Palantir be classified in this if you actually have an idea about their fundamentals? This is a company with $0 in debt ever since 2021. They are a company that are sitting on $2.5 billion in cash, which means they don't need to take leverage or debt, which means they're completely insensitive to interest rates whatsoever. And this is a company that's about to close this 2021 in a few days at a $1.5 billion revenue with about $400 million in free cash flow. People seem to forget that Palantir is operationally profitable for 3 quarters already. People don't understand that stock-based compensation that brings the actual profitability is not a cash flow item. It's an accounting item. So Palantir will close this quarter with a $400 million in free cash flow for the year. Now, we're also talking about a company that has some of the richest clients in the business. I mean, they have government clients, massive government clients, but also only Fortune 500 companies really on its business roster. So these are companies that are completely insensitive to marginal price increases due to inflation. So a company that has no sensitivity to increased rates and a company that can easily raise their prices with the clientele that they actually work with, that doesn't have a lot of competition, in fact, none, and we'll talk about it in a second, that might change in a few years, and doesn't really have to put any money in order to increase the output. So they don't have to invest in CapEx to increase the amount of services they provide because it's a SaaS business. So the question is, should a company like that be included in bad growth stocks? Because I think the disparity here is actually very amusing. Palantir, the company, not Palantir the stock, Palantir the company had one of the best years in its existence in 2021. And yet Palantir the stock is lagging behind like a piece of fart that everybody just wants to forget about because how embarrassing that was. And I think this kind of dissonance, if you want to call it, or arbitrage, whatever you want to name it, can create massive opportunities for people who actually understand what Palantir is and what it isn't. Because what we have with Palantir is a company with 80% gross margin. Yes, I just said 80%. A company that's currently trading at 19 price to sales. And don't forget that this whole narrative of Alex Karp is now gone because the man finished selling the stocks he needed to exercise the options from 10 years ago. So Alex Karp won't be selling for at least a decade longer. Stock-based compensation that they gave out to attract some of the best employees in the market, which they did, is actually down by 40% in Q3. So stock-based comp is coming down. Alex Karp is done selling. Their margins are phenomenal. Free cash flow is insane. And yet people are talking about how this stock should be avoided at all costs. Unbelievable. And here's the funny part. For the past few weeks, we had a lot of short sellers jump the boat. We went from 3% short interest to 6.5% short interest on Palantir. So we doubled the amount of short interest in this company. And I'm going to enjoy watching these guys get slapped by a rubber band once this thing gets released. Because with every short selling pressure, and you have to understand that the current price is definitely affected by 100% increase in the short interest. Eventually, if the business is good, this rubber band will release. Whether you want to call it a short squeeze or whatever, it doesn't really matter. But they're playing a very dangerous game, the short sellers that is. And they're going to get shellacked. And I'm going to be sitting there with my popcorn and my tea, enjoying every goddamn second of it. And the $15 question here is, how much is Palantir worth, even at the most bear case possible? Because it's not really that difficult to give you the bull case here and to say, well, this is a $500 stock. So the real question is, what if the interest rates actually go up to, let's say, 10%? And let's say that Palantir only grows 30% per year for the next 5 years. They don't explode out of the stratosphere. Let's assume they're going to spend $200 million in capex in the next 5 years. Let's throw a bunch of bearish assumptions into the model and see, in the worst case scenario, how much Palantir should be valued at right now. So let's do it. On the screen right now, you're seeing my DCF model for the bear case for Palantir. I assumed a 30% annual growth from 1.5 billion onwards for the next 5 years, which is basically the bear case for Palantir if you know the business of this company. I assumed an 80% margin on the cost of goods. SG&A and R&D expenses are right here in front of you with a nice little growth every year. But I also added some bearish assumptions. For example, I assumed that they will pay 21 nominal tax, which is not true. Companies never pay 21% nominal tax. Also, I've absolutely ignored any net operating losses they have from former years, which they can use for tax credit. So I don't think Palantir will pay taxes anytime in the next 5 years, even if they make that money, because there's so much accumulated losses over the years. But let's assume they pay taxes from the first dollar. Let's just assume they also have capex expenses of $200 million for the next 5 years, which is, again, a total insanity. And let's assume a 10% weighted average cost of capital. Let's just say that the interest rates go up to an insane amount, giving us a 10% weighted average cost of capital. And let's assume a 4% perpetual growth. And as you can see right here, it's going to give us a nice $44 billion valuation. Now, the company is currently trading at $29.2 billion, which means it has a massive upside. But hold on a second. We still have the EBITDA multiple. You have to look at the multiples. This is a company that should be multipled at 25, but I use 18 just to keep it conservative for no reason other than that. And I'm getting $55 billion for that as well. I always average them out, and if I average them out, I'm getting 49.6, and that is a 70% upside right now, today. And if you want to play around with this model yourself and change the numbers, the parameters, and see what you get based on this template, you can get it on our Patreon page. It's $5 per month. You'll get this DCF as well as a bunch of others, participate in our Zoom calls, but mainly, you'll be supporting the channel. And I think that's important in itself as well, because we don't really try to monetize in any other way besides the Patreon page, which keeps the lights on, I guess. So the question is, if this company is 70% undervalued right now, on the worst bear case possible we just presented to you, an insane bearish assumption gives us a 70% upside. Why are people ignoring this? Because essentially we have a company here that's just about to give you 1.5 billion in revenue with an extra 3 billion in secure transactions that they already have lined up. So even if they don't sell any more projects, they can give you 1.5 billion for the next 2 years after 2021. Nobody, of course, talking about that. A company that just beat their own revenue expectations for Q3 instead of 30%, 44%. Of course, nobody talking about that. And don't get me wrong, I'm not complaining. I don't mind buying a 70% upside stock at $15 and letting everybody just sit around and laugh at me, and then we'll see what happens next. No problem. I also don't understand people who seem to be annoyed by this. If you're a Palantir investor and you haven't done margin or you haven't used options, you just straight up bought stock, you shouldn't be concerned right now. You should be just sitting back, drinking your tea, and enjoying this carnage, because you know what's going to happen after that. And of course, if you use leverage or use options, that's a whole different deal. But I told you that this is a prime example of why I don't use not options and not leverage, because now I get to sit back, enjoy, and drink my tea.